Okay, it's 11:01. Time to get the show on the road, I think. This week we've got a special guest again, and it's going to be David Cornell, who's the CIO of Ocean Dial, who the managers of Indy Capital Growth, and that's one of the sort of key stories this week. So should be worth listening to. Just a sort of housekeeping thing, we've slightly changed the way it works this week, slightly different software, but it more or less the same. If you want to ask a question, you do it through the Q&A now, rather than the chat, or just email me at jc@martin&co as usual. So instructions on every page, so hopefully that should be obvious. And we'll handle the questions at the end as normal. So obviously a nice short week. The four stories that I picked out this week, Indy Capital Growth, because it's brought forward a continuation vote that would have happened probably in August, I think, and it's now going to happen in a couple of weeks' time. And that's what we're going to be talking to David about, so I won't preempt that. We also saw the board of SQN Secured Income come out and say that people should vote against continuation of that fund. We had a new NAV from Aberdeen Standard European Logistics, which is particularly what's going on in that market. And we've had news this morning that GCP Infrastructure is going to cut its dividend, and I wanted to address what's going on there. So they're the sort of four topics. If there are any other questions and news that you've got this week, then by all means ask them. Let's start then with SQN. Now this sector sort of boomed with much fanfare and then has really struggled in recent years. And you can just tell you've got Hadrian's Wall in the act of turning itself into cash and handing back money to shareholders. Same thing going on at what was Ranger, now RDL realisation. Riverstone Credit suffering a bit there. SME Credit, the old funding circle thing, that's still, languishing on a big discount. So these things haven't really covered themselves in glory recently. And SQN, I suppose, is not really alone in this. It wasn't doing too badly, though. This is a chart from their fact sheet. And you can see that it was a nice sort of steady performer until about a year ago. And then it was flat for a year, and now it's just been tailing off. And the tailing off, really, a lot of that is kind of COVID related, but I suppose that's something you've got to be bearing all in mind. But the other thing it was doing all the way through this, it was paying a decent yield out, and it was really over distributing. And you can see that in the steady drip decline in the NAV. It's not huge until recently, but it is definitely a factor. I mean, given that people were obviously investing in these things for yield and it was over distributing, it was really coming to a point when that wasn't going to be sustainable. One of the things the board wanted to do was grow it. And so they said, well, we're going to keep it going for a bit, but on the condition that it gets to 250 million of assets. And it never managed to grow at all. And for that reason, and I think because of the recent performance as well, which is going to make it very hard to raise any more money, the board said votes continuation. But it's also warned that it's going to take at least 3 or 4 years to wind the portfolio up. It's got a bunch of things in the portfolio. I think the longest maturity of the debts is about 5.9 years. And it can't, there's no mechanism in the loan structures that allows it to demand early repayment. So it's not going to be able to wind the fund up early from that point of view. And it's also cautioning that given what's going on with the COVID stuff, some of its borrowers might come back and say, we need more time to pay, so we might have to end up granting extensions on the debt repayment schedule, which means it could take even longer to wind up. I think there was always an underlying possibility that SQN would try and stick the two funds together, SQN Asset Finance Income and this one. The whole reason for it going to SQN in the first place was that he was a manager that was doing great things and had a good reputation, and everybody loved it, and they had the marketing machine to grow the fund. And obviously, just shortly after that, SQN Asset Finance Income blew up, and that didn't work at all. Dawn Kendall is the manager of this fund, who actually I quite rate. She and one of the other guys at SQN are going off to venture backed by an Icelandic bank called KKV, and they are going to have a go at turning SQN Asset Finance Income around. My guess is that they will just look to merge these two and then manage it out so that people who do want cash can get cash back. So we'll just wait and see what happens. Aberdeen Standing European Logistics. I thought this is worth mentioning, just because you look at those discounts on there. I mean, actually now, because of what's happened this week, it's trading on one of the tightest, but it's still trading on discount. I think this is one of the sectors that's actually a beneficiary of what's going on. And so it seems a bit perverse that these things are trading discounts at all. The yields are all quite attractive. But you can see here, it's not quite 3 years old yet, but just look at the 1 year returns. It's by far the best performing of these. And so, you know, you have got a positive 16% return over the past 12 months. That's not bad, really, in this environment. And it really comes down to the demand for the logistics sheds and stuff that they've got. This is the sort of thing they've got. This is their Biocoup warehouse in Avignon, which you can see is a massive great thing with solar panels on the roof, and it's organic food distribution. And the trend towards e-commerce generally is driving the demand for this stuff. And you can see this is slightly out of date because it only goes up to 2017, and I had I had more time, I would have tried to update this. But Europe is still a long way behind the UK and the US in terms of e-commerce. And one of the things that might be happening with COVID, and it definitely seems to be in the UK at least, so I'm expecting it to happen in Europe too, is that because people are being forced to stay at home in lockdowns, they are going to shop online more, and grocery shopping in particular. So that's going to drive the demand for these distribution warehouses, which means that really they can't build them fast enough, which should be great for yields going forward. To be fair, not everything is perfectly rosy. The NAV has gone up. So between the end of December and the end of March, their NAV has gone up from 111 euro cents to 112.7. In sterling, that rises even bigger because sterling's been weaker. So they've gone from 94.2p to 99.9, which is all good. But they haven't actually collected all their rent that was due. So they reckon that they're going to get 82% of what was due to them over the next couple of weeks. Some of it they've had to defer. They've got, I think, 6 tenants that have said, look, given what's going on, we really can't pay you right now. So what they've extracted from them is, okay, well, if you want time to pay, then we're going to extend your lease and get the money back another way. So that should be okay, I think. I mean, it is generally, you can see what's going on in other bits of this market. Urban Logistics this week said it saw its NAV go up by 4.6%. Again, I think that's just a symptom of what's going on across the whole market. So all of these things are trading on discounts that are probably just too cheap. The counterpoint to that is, if you're in old-fashioned retail, you're really struggling. I mean, the chief executive of Hammerson resigned this week, just couldn't handle it, I suppose. And the NAV, the property, only the British Land's property portfolio dropped by 10% this week. And that was really all down to its retail property portfolio. That's fell by 26%. But But not all retail, high street retail, is necessarily awful. Even though it's got a lot of shuttered shops at the moment. Shaftesbury this morning, it seems to be potentially the target of a bid. Something that we've reported on the news there. It owns a big chunk of property in Soho. And there's a company called Capital & Counties that owns a big chunk of Covent Garden. And Capital & Counties are bidding for a big stake in Shaftesbury this morning. There's the rumours anyway, so we'll see what happens. So that could lead to some consolidation. But generally, I mean, even though those sort of West End retail might be okay, general high street retail is still struggling. And if you want to have exposure to any part of the property market, then this urban logistics, sheds, national distribution centres needs to be the place to be. And so I'd recommend that. Moving on. GCP. All of these things are trading on premiums. We ignore infrastructure India. This is a total basket case and hopefully will disappear at some point. So they're all trading decent premiums. They all pay reasonably good yields. GCP, as you can see there, stands out. It's been much, much higher than the others. It was launched about 10 years ago. And the returns have been pretty good, as you can see from this lot. And it was launched to invest in PFI assets. So it was providing debt finance against, subordinated debt finance against PFI type assets, schools and hospitals and that sort of thing, which was a great market to be in. When they launched, it was, we were just coming out of the financial crisis. It was still quite hard to borrow from a bank. And lending to this area of the market was really quite profitable. But what we've seen, just get over this right now, just the normal returns on sort of relatively risk-free assets have plunged since it's been launched. So that's the yield on 10-year gilts. But interest rates, all those sort of things, they've all been falling. And GCP has been maintaining its dividend. As people got more comfortable with investing in PFI type stuff, they had to look elsewhere for things. So let's just go back to this one again. So now they went into renewable energy. So they finance things like solar and wind and anaerobic digestion plants. They've also gone to supported living, the sort of thing that Civitas and Triple Point are invested in. These are all sources of decent levels of income that are backed by government or quasi-government bodies. So relatively secure income, but relatively high yields, especially relative to the yield on gilts. But they're paying out sort of steady 7.6p a year in dividend for the last 7-8 years. And that really doesn't look like it can be sustainable given what yields are doing. Because as things get repaid, it's harder and harder to find new investments at the same level without taking more risk. So the board have said this morning, we're going to rebase the dividend, but they're not actually cutting it by that much. It's going down from 7.6p to 7p. So it's still going to be yielding 5.9, which if you come back to this one again, it's still going to be quite attractive against this thing. And the Sequoia is going to be slightly higher. That's all. And we'll see what happens with that. So that's enough of me. As usual, if you've got any questions about that, we'll wait and ask them at the end. I'm now going to bring in David Cornell to talk about India capital growth. We'll start off with, my question what went wrong with IGC, maybe it's a bit rude, but it was doing incredibly well a couple of years ago, but performance more recently hasn't been that good. I know you've been doing some things to tackle that. So do you want to just sort of give us some background, please, David, about how the fund's been doing, what's been impacting the performance, and what the changes that have been made are?
Sure. Hi, everybody. Thank you, James, for asking me on to this event. And So I think, as you rightly say, IGC performed incredibly strongly immediately post the election of Prime Minister Modi back in 2014, all the way up until kind of mid-2017, late 2017, compounding at around 30% per annum in sterling terms, and comfortably beating its benchmark on a relative basis by around about 17% over that period. Things started to go wrong in late 2017, and there were really three reasons from a macro perspective why mid and small cap equities underperformed and fell in absolute terms. So I'll just touch on those, and then I'll talk a bit about why we've underperformed from a relative perspective, because that's also obviously important. The first point is that late in 17, mid-cap equity valuations had reached a peak both in absolute terms and relative to large caps, around about a 20% premium, I would say, in aggregate. And we took a decision at that point as an investment team to try and mitigate some of that risk in valuations without wanting to be out of the market, particularly to increase the number of stocks in the portfolio, so to reduce the concentration risk, and to make additions in the portfolio further down the market cap curve to move into the smaller sized companies where we saw the potential for more value, given this premium that mid caps were trading on, and a reluctance to buy the large caps because obviously the mandate doesn't allow us to do that materially. But what happened actually was that there was a massive rotation out of mid caps and into large caps late 2017 that ran all the way until December 2019. Actually, in keeping with a global trend, I think, to buy very expensive, very high quality kind of growth companies. And in India's case, the concentration of performance in large caps was only limited to 4 or 5 stocks. Everything else went through a very torrid time as the Indian economy was kind of losing a bit of momentum for various reasons, which I can discuss in due course. So that's point number one. I had massive rotation out of the asset class, and mid caps underperformed large caps, and small caps underperformed mid caps. So we were kind of hit two ways, really. Mm-hmm. The second thing was that as a consequence of I guess an unintended consequence of a lot of the structural reforms that Prime Minister Modi has put in place in India, all of which I think are good and will benefit over the long term, it led to a default in the domestic bond markets of a quasi-government lender called IL&FS, who defaulted on its short-term paper. And this led to a massive liquidity squeeze as confidence evaporated in the Indian credit and equity markets. And it had a very real impact on the small and mid-cap area of the market, which, of course, is very dependent on capital markets, and particularly the debt markets, for raising capital in which to grow. Mm-hmm. And that had a severe impact on our portfolio, particularly our financials exposure. We've long had the view that the kind of the financial inclusion, or the I would say the sort of the bringing of hundreds of millions of Indians into the financial community through better technology and opening bank accounts is a theme we kind of strongly believe in and still do. But it had a material impact on our financials exposure because of the liquidity squeeze and the impact it was having on some of the quality of the asset books and some of the banks we owned. So I guess we had a problem, particularly in financials, but also in consumer stocks as well. That's another strong theme that we've been playing and we continue to believe in most intently in the rural parts of India, where we think incremental consumption in rural India can be very strong going forward. So, but again, the liquidity squeeze had an impact on consumption, and both our financial stocks and our consumer stocks have been heavily derated from the sort of mid-cap P premiums I was talking about at the back of 17 to where we sit today, which is kind of almost at 15-year lows. So that was the second reason, and the third reason was the kind of onset of COVID, beginning of the year, and mid and small cap Indian equities are not necessarily the place you want to be in the first instance when a pandemic hits risk assets, and that's had an impact on absolute returns and on relative performance as well. I want to also make it very clear that those events shouldn't mask the fact that we've had some stock picking mistakes in the portfolio, particularly moving down from the mid caps to the smaller caps, where corporate governance issues are greater, where it's harder to sort of get enough information on the companies and to get confidence in the companies. And we have made mistakes there, and those stock picking mistakes have led to the underperformance. And as you will know, and many of your listeners will also know, I'm sure, that it's very often just one or two stocks in a portfolio that does the damage. I guess the other point I should make, if I'm being completely honest with you, is that there has been a reluctance in the investment team, I think, to react to some of those macro events that I was referring to. And we tend to have very long holding periods for stocks, and we've been sitting on stocks that haven't been working because they're getting cheaper, and that's caused a kind of drag on performance as well. So.
Okay. It might be useful just to explain to the people listening how the management of the portfolio works, because you're based in London, but there's a team in India as well, isn't there?
Yeah, that's right. So the team in India are responsible for the construction of the portfolios and for doing all the equity research into our investee companies. So there's a team of 2 portfolio managers, Trilid Patak and Gaurav Narayan, and then 5 analysts, sector analysts, who support them on both India Capital Growth and on our open-ended fund. And then as a CIO sitting in London, I act as the overall kind of risk manager, I would say, and all the trading is done from London. So the team in India effectively advise me as a CIO on what they want to do and when they want to do it. But we don't in London get involved with the day-to-day running of the portfolios. That is, the team in Bombay is fully empowered to do that.
Okay, cool. So, but the upshot of all of that is obviously the performance hasn't been matching the benchmark, and so the board has decided that it was going to trigger a continuation vote, and they're going to bring that forward. So you've taken a number of measures, I think, to try and put things on a surer footing for the future. Do you want to sort of run through what they are?
Yeah, certainly. There are 3, actually, and I should point out that this has been a work in progress for about 7 or 8 months now. Mm-hmm. The performance has been poor for 3 years, but actually the breakdown really happened in the last 12 months. And we've been taking some quite meaningful steps to address these issues. The first has been to strengthen the investment team. And we've appointed a co-head of equities alongside Gaurav, who is responsible for stock selection in the investment trust. We appointed a co-head to work alongside him with 30 years experience of Indian equity markets, and then 2 additional analysts in support, 1 senior and 1 junior. So we've got 5 analysts now supporting 2 portfolio managers, a stronger, more experienced and more settled team, which is important. The second thing we've done is to close our Emerging India Fund, which was to some extent a competing fund to IGC. Gaurav was running both, or was responsible for stock selection in both. And I think that was causing some issues. And the Emerging India Fund wasn't growing, and it was not only absorbing a lot of his time, but also it was unclear, I think, how those 2 can sit next to each other. So we've closed that, and his focus is now back on IGC, on the investment trust, 100% of the time, which is already starting to make a difference, because his kind of bandwidth, you could say, is fully apportioned. We've made some quite big moves to tighten up the process because of this sort of small cap drift I referred to earlier. The team's now working off an investable universe of 140 stocks, which are all pre-approved at through an investment committee process, a qualitative and quantitative screening process. And the investment managers can only pick from this list now. So they are picking from a list that has already been through quite a rigorous screening process. And that, to some extent, restricts their ability to sort of deviate from a chosen path. The added benefit of the universe is also that the analysts that maintain the stocks have a much more focused approach, because now they cover 30 stocks each and 30 stocks only, and they live and breathe those stocks 24/7, and it helps build conviction and through depth and knowledge of understanding. And I think previously we were running around chasing all the new ideas and looking for value in all sorts of strange places that wasn't working. So this is a much more focused approach. And I think the final point about the universe is it's helping us to integrate what we call our non-financial analysis to small and mid-cap companies in India. From an ESG perspective, it's very important that we understand how the corporates are addressing a lot of these concerns, and we think as bottom-up stock selectors, we have a lot of value to add in that regard, in terms of our understanding of how they approach it, not in terms of how we can help them, but how we understand what they're doing and what that means for performance going forward. So those are the things that we've done. We've added quite a lot of artificial intelligence software to our process to try and improve analyst productivity. Aggregation of unstructured data through AI is really helping in terms of bringing down the time it takes to sort through all the information that's required, and that's quite positive. And we've also put a ranking tool together that helps the fund managers understand how their stocks are valued relative to others in the universe.
Cool. Okay. So actually, has that meant many changes in the portfolio?
Yeah, it has actually. Historically, as you know, turnover has been very low. That's picked up substantially. I mean, not substantially. We're now at about 25% turnover rather than 12% turnover. So doubled off a low base. But 15% of the portfolio is new. 5 new stocks. None of them are private sector banks or consumer-facing companies. So fresh ideas. A general insurance company we bought, which is doing very well. The COVID sort of scenario is helping to drive demand for general insurance and health insurance. We bought some gas-related companies as India's economy gasifies in an attempt to become cleaner, both logistics and domestic gas use. We bought India's largest commodity exchange, which is benefiting from volatility in the short term, but also from a kind of networking effect along lines of other stock exchanges globally. So yeah, some new ideas, and what's more, they're actually working. The outperformance that the aggregated component of new ideas in the portfolio is starting to generate some positive returns. So we're very excited about that.
Cool. Okay, good. We should talk about COVID-19 and specifically what's going on in India with respect to that, because yeah.
I mean, it's a tough one, isn't it? Very quickly, India, in terms of its approach to COVID, prioritized health over economics, as you would expect, has put in place what is considered globally to be the most stringent of all lockdowns, which went in place on the 25th of March with very little notice, and caused a lot of short-term disruption to people's lives, particularly migrant workers who were stuck in the cities, who couldn't get home, and there was a lot of kind of media coverage about the way in which the government in India handled that. The government has, the pandemic has not spread in India as had previously been expected. And if you look at the proportion of people being tested that have been tested positive, it's very low relative to other countries. And actually, if you look at the number of districts in India that have suffered, it's also quite low. The rural areas have been relatively immune, the urban areas less so. The economic impact very hard to gauge right now, but along the lines of every other country globally, this year's earnings are write-off, next year's earnings possibly a write-off. We're trying to figure that out. What I can tell you, anecdotally, because we talked to a lot of people on the ground in lots of different parts of the country, are the hospitals full? No. Are the chemists running out of drugs? No. Are there people visibly suffering on the streets from COVID? No. So there's a lot of skepticism about the data coming out of the government, but the on the ground, bottom up sort of feedback from all sorts of different people in different parts of India is that the thing has been relatively well contained. So, whether that's because they're a few weeks behind us or not, I don't know.
Cool. Okay, that's encouraging. So, assuming shareholders now vote for continuation, what are they going to get? So, you've had a bit of a jump in the share price since all this stuff's been announced. I think it was on 34, 35 discount, and now it's about 21.
Yeah, the market's been going up a little bit as well, James. So the discount, to some extent, the discount's staying wide despite the NAV going up.
Cool. So what is the sort of upside for shareholders, and what measures have you taken that will help them give them peace of mind?
Yeah. So I think what we're arguing is that the valuations in India, particularly in mid caps, are at 15-year lows. It's not a good time to be forcing liquidation, despite the poor performance that the manager has delivered in the last 3 years. And that the combination of a turnaround in investment performance on the back of the changes that I've highlighted, combined with a cyclical recovery in India's economy, which we believe is long overdue and was starting to appear prior to COVID, combined with a kind of reversal of this large cap, mid cap underperformance, which has been going on for 3 years. Those three things could all be very positive for the NAV. And that, combined with the steps that the board has taken to ensure that the share price trades more closely to the NAV by giving investors a guarantee that they can get their money out at close to par in 18 months' time, the combination of those things should far outweigh any short-term upside that investors might be tempted to take by voting for liquidation. So, mean reversion of the discount, mean reversion of performance, mean reversion of mid over large, combined with an economic recovery in India, could actually be very punchy for the share price.
Cool. Okay. Good. Well, I think we should probably ask some questions now. Let's just see what we've got on the Q&A stuff. So one of the questions here, I think, it's just really what's the catalyst for a rebound in the Indian stock market. So if you set aside COVID for the minute, what were people looking for? Right, because it was, what's going to be the catalyst to make it go back up again?
I mean, the government's been quite proactive in terms of injecting liquidity into the economy in India, as has been the case all over the world. India is a big beneficiary of lower oil prices, huge beneficiary of lower oil prices, and that's to some extent an additional injection of monetary stimulus as the economy benefits from buying oil at half the price it was a year ago. So I think those are kind of very short-term aspects. I mean, proactive monetary response, a fiscal response from India, albeit not huge, because they don't have a lot of fiscal flexibility. And I'm glad that they're not using that particular tool. I actually think the most important thing will be a sort of re-energizing of the structural reforms around land and around labour that can unleash a lot of productivity improvements in India that have stalled. And you know, a lot of people in India are talking about this being a 1990, 1991 moment, which some of your listeners may recall when Manmohan Singh, as the finance minister in India, went on the back foot economically, was forced to open up the economy, and it was a kind of launch pad for 20 years of rising growth in India and very strong stock market performance. We think that, you know, with his back against the wall, Mr. Modi is talking about a lot of structural reform again, particularly taking advantage of some of the supply chain disruption fears that exist around China at the moment, and whether India can position itself as a reliable alternative option. And if they can capture that, any small part of that market share, then I think the economy's got a lot of potential. And the other point, I think, finally, is that, you know, a lot of the good work's been done. You know, Mr. Modi's made a lot of structural changes that have had a short-term negative impact on growth. When they start to benefit, you know, it could be very strong. Could be very strong.
Oh, okay. Are you going to change what you invest in? Are you going to invest in more large caps?
No, we're not. And we're not. We have a mandate to invest in small and mid cap equities in India. We see much more value, and we have a much more active. I mean, we're an active manager. We like, it's a selection of our best ideas, and we think, you know, large caps, you can buy a tracker for those. This should give you a real active management, and we think that the domestic engine room of India, which is what investors generally want when they buy exposure to India, it is, you know, comes in the small and mid caps area of the market, unquestionably.
Okay, cool. Yeah, just question about politics. So, I suppose the general question is, to what extent are the sort of government reforms hindering or encouraging the growth of India? Because they've seen quite a few things happen recently with goods and services tax, things like that, and the response has been that Indian growth has slowed. So, are they long-term benefits still, these things?
Yeah, they are. I mean, I think we probably, I think the implementation of some of these reforms has been badly handled. Demonetisation is one, which is very controversial. Goods and services tax, another, which has been tough to implement, and a lot of people kind of, you know, struggling to get on the platform. And you know, the Insolvency and Bankruptcy Act, although very positive because it takes control back from the borrower and gives it back to the lender, has had a, you know, impact on asset quality. All these things are hugely productive for the Indian economy. There's a lot of conflicted interest, don't forget. You know, we're moving away from a sort of patronage-based system based on bribery and corruption to a rules-based system. And there's a lot of people who stand to lose a lot as the country progresses. And so the implementation is fraught. And I think the Prime Minister and his team are doing a very good job, but it takes a lot of time. And what happens is, you know, as we saw in June 14 to June 17, when the market did very well, you know, the market's very excited about it. And then when it doesn't come through as fast as people were expecting, they get very depressed about it. And the glass goes from being half full to being half empty. Now we're half empty again. The reality is that there's a lot changing, and it's all very positive. And it won't be long before the glass is half full again.
Cool. Okay. Good. All right. I think we can probably leave it there. Because I know that you've got another webinar planned for 12 o'clock, so I should probably let you go and prepare for that one. So there are two webinars set up for David to talk through the board's decision and proposals for the future. And there's much more information about them on the Quoted Data website. which if you look at the events section, is actually the first thing there, India Capital Growth webinar. So there's one today at noon and one on the 3rd of June at noon. So go and check those out. And actually, we published a research note recently on this as well. So by all means, go and have a look at that. So thank you very much for that, David. All very interesting.
Thank you, Jay.
And good luck with the future. Next week, we're talking to Scottish Mortgage. So I'll talk to you all then. Thanks. Bye-bye.